The markets are in turmoil, investors are on edge. Today, the Dow Jones Industrial Average plunged a staggering 716 points, marking a significant escalation of the recent market decline. This dramatic drop reflects a growing sense of unease among investors about the health of the U.S. economy and the potential impact of escalating trade tensions. The S&P 500, a broader measure of the U.S. stock market, also took a significant hit, falling by 1.97%. This decline puts the S&P 500 on track for its worst quarterly performance since 2022, a sobering reminder of the market's vulnerability to economic headwinds. The tech-heavy Nasdaq composite followed suit, tumbling by 2.7% as investors fled from growth stocks. Fueling the market's anxieties is the persistence of inflation. The Personal Consumption Expenditures, or PCE price index, a key measure of inflation closely watched by the Federal Reserve, rose by 2.5% in February from a year earlier. While this figure was unchanged from January's reading, it remains stubbornly above the Fed's 2% target, signaling that inflationary pressures are not abating as quickly as hoped. Of particular concern is the rise in core PCE inflation, which excludes volatile food and energy prices. Core PCE inflation accelerated to 2.8% in February, up from 2.7% in January. This uptick suggests that inflation is becoming more broad-based, with price pressures building even in areas that are typically less volatile. The relentless pressure of inflation is taking its toll on American consumers. The University of Michigan's Consumer Sentiment Index plummeted by 12% in March, hitting its lowest level since November 2022. This sharp drop reflects growing concerns about the rising cost of living and the potential for a recession. Consumers are increasingly pessimistic about the economic outlook. They are worried about the impact of inflation on their wallets, the possibility of job losses, and the overall direction of the economy. This decline in consumer confidence could have significant implications for economic growth, as consumer spending accounts for a substantial portion of U.S. economic activity. Adding fuel to the fire are renewed trade tensions. President Trump announced plans to impose a 25% tariff on imported cars and car parts, a move that sent shockwaves through the market. The tariffs, which are set to take effect in the coming months, have raised fears of a trade war that could disrupt global supply chains and damage economic growth. The auto industry in particular is bracing for impact. The tariffs are expected to raise prices for consumers, potentially dampening demand for cars and trucks. Automakers are also concerned about the impact on their supply chains, as many rely on imported parts to manufacture their vehicles. Section 5. Automakers brace for impact, a wrench in the gears. The specter of a trade war with one of the world's largest auto markets, China, has sent shivers down the spines of auto executives. The tariffs, if implemented, disrupt the delicate balance of global supply chains, potentially leading to higher costs and production delays. For consumers, the tariffs could translate into higher prices for both new and used vehicles. This comes at a time when affordability is already a major concern in the auto market, potentially dampening demand and impacting sales figures. The uncertainty surrounding the tariffs has also cast a shadow over future investment plans, with automakers hesitant to commit to major projects until there is more clarity on trade policy. Section 6. The Fed's Balancing Act, Navigating Inflation and Trade Wars. The Federal Reserve now faces the unenviable task of navigating an increasingly complex economic landscape. The central bank is caught between its mandate to control inflation and the potential fallout from a trade war. The Fed has already raised interest rates twice this year in an effort to keep inflation in check. However, the escalating trade tensions and their potential impact on economic growth have raised doubts about the pace of future rate hikes. The Fed is now in a wait-and-see mode, closely monitoring economic data and assessing the potential fallout from the tariffs. The central bank will need to strike a delicate balance between containing inflation and supporting economic growth, a task made all the more difficult by the uncertainty surrounding trade policy. Section 7. Investors seek safe havens. Bonds rally amid uncertainty. Amid the market turmoil, investors are seeking safety in U.S. government bonds. The yield on the 10-year Treasury note, a benchmark for borrowing costs, fell sharply to 4.26%. Reflecting increased demand for these safe haven assets. This flight to safety underscores the level of anxiety in the market and the growing belief that economic growth may be slowing. Gold, another traditional safe haven asset, also benefited from the market's risk-off sentiment, with prices surging above $3,100 per ounce. Bitcoin, often touted as a digital gold, bucked the trend, falling by more than 3% as investors sought the perceived safety of traditional assets. Section 8. A market adrift, volatility and uncertainty reign supreme. The sharp market decline and surge in volatility are indicative of a market grappling with a confluence of challenges. Investors are facing heightened uncertainty on multiple fronts, including persistent inflation, the potential for a trade war, and slowing economic growth. The CBOE Volatility Index, also known as the market's fear gauge, surged by more than 16%, reflecting the heightened level of anxiety among investors. This uncertainty is likely to persist in the near term, as the market awaits clarity on trade policy and the Fed's next move. Until then, investors should brace for continued volatility and be prepared to weather further market swings. Section 9. Looking ahead, a cloudy crystal ball for the economy. The outlook for the U.S. economy remains uncertain. While the economy has shown resilience in recent years, the combination of rising inflation, trade tensions, and a potential slowdown in consumer spending poses significant risks to the outlook. The Atlanta Fed's GDP-NOW model, a real-time tracker of economic growth, is currently forecasting a sharp slowdown in economic growth in the first quarter of 2025. The coming months will be crucial in determining the trajectory of the U.S. economy. If inflation continues to exceed expectations, the Fed may be forced to raise interest rates more aggressively, potentially dampening economic growth. Moreover, if the trade dispute with China escalates, it could further weigh on business investment and consumer confidence. The path ahead for the U.S. economy is fraught with challenges, and investors should proceed with caution.